Welcome to Smart Money Hub, where knowledge meets entertainment. Get ready to embark on an exciting journey of discovery and learning. Whether you are a curious learner, a passionate enthusiast, or a seeker of valuable insights, you have come to the right place. We are here to entertain, educate, and inspire you. So, without further ado, let's jump right into today's exciting topic. In the ever-evolving landscape of finance, a new contender has emerged, poised to challenge the monetary system as we know it. Welcome to our video on Bitcoin versus traditional banking, where we unravel the differences between these two approaches to money and explore the potential impact of Bitcoin on the established financial sector. Let's begin by examining the fundamental differences in how these systems operate. Traditional banking relies on so-called fiat currencies, which are based on trust in the authority of central banks. These currencies, such as the US dollar or the euro, are created and regulated by central banks through a process called monetary policy. Fiat currencies derive their value from the trust that people place in the issuing authority and the belief that they will be accepted as a medium of exchange. However, it's important to note that fiat currencies are created as debt. When central banks introduce new money into circulation, it typically involves the issuance of government bonds or loans. This means that each unit of fiat currency represents a claim on future repayment, and the value of the currency is ultimately backed by the promise of the government to honor its debts. In this context, it's important to note that fiat currencies are always susceptible to inflation. Central banks have the power to increase the money supply, which can lead to a decrease in the purchasing power of the currency over time. This inflationary nature erodes the value of people's savings and assets. In contrast, Bitcoin operates on a different principle. It has a limited supply cap of 21 million Bitcoins. This means that there will only ever be a finite number of Bitcoins in existence. This scarcity is built into the system's protocol and is one of the key features that differentiate Bitcoin from traditional currencies. The prevention of inflation is a significant advantage. Due to its fixed supply cap, Bitcoin is resistant to the inflationary pressures that fiat currencies face. This means that the purchasing power of Bitcoin tends to be more stable over time. The predictability of the Bitcoin supply and the absence of a central authority controlling its issuance provide individuals with a level of confidence in the long-term value of their holdings, as hyperinflations become impossible. By operating on a fixed supply, Bitcoin introduces a new paradigm in monetary systems, offering an alternative to the inflationary pressures faced by traditional fiat currencies. On the other hand, Bitcoin operates as a decentralized digital currency independent of any central authority. It is based on a transparent and secure blockchain network, which serves as a public ledger of all Bitcoin transactions. The creation and distribution of new Bitcoins are regulated by the network's consensus rules, rather than being controlled by a central entity. The traditional banking systems grant custodial control over your money to financial institutions, which can impose limitations, freeze accounts, or restrict access to funds. With Bitcoin, on the other hand, you have full control over your digital assets without the need for third-party intermediaries. This financial autonomy empowers individuals to be the sole custodians of their wealth. Additionally, the transparency of the blockchain allows for a verifiable and auditable record of all transactions. Every Bitcoin transaction is recorded on the blockchain, providing a level of transparency that is not easily achievable with traditional banking systems. This transparency enhances accountability and reduces the potential for fraud or tampering. In summary, the differences between traditional banking and Bitcoin are profound. While traditional banking relies on fiat currencies backed by trust in central authorities and operates through a debt-based system, Bitcoin operates as a decentralized digital currency based on the transparent and secure blockchain network. The rise of Bitcoin has the potential to disrupt the traditional financial sector in profound ways. As a decentralized and open-source digital currency, Bitcoin challenges the monopoly of central banks and offers an alternative to the existing financial infrastructure. In conclusion, the stark differences between Bitcoin and traditional banking systems highlight the unique advantages Bitcoin brings to the table. Its asset-based nature, limited supply, and control over funds offer an alternative vision for the future of money. As Bitcoin continues to gain traction, it has the potential to redefine the financial landscape, creating opportunities for individuals to engage in a more open, inclusive, and empowering financial system. Alright, that wraps up our comparison of Bitcoin and traditional banking. Thank you for joining us on this journey of knowledge and discovery. If you have any questions or topics you'd like us to cover, please leave a comment below. We hope you found today's video informative and engaging. If you enjoyed this content, don't forget to give it a thumbs up and share it with others who might find it valuable. And remember to subscribe to our channel for more captivating videos just like this one. Hit that subscribe button and click the notification bell so you never miss an update. Also, be sure to check out our other informative videos in the playlist or suggested videos section. there's a wealth of knowledge waiting for you.